All right, so we started the week off, a pretty busy week with earnings and economic indicators due out, as well as the FOMC meeting this week. So we got a pretty busy week, but we started off with very, very small range. Not really a whole lot going on. We talk about in today's video, then how do we deal with this? How do we deal with this slow grinding trend higher, as well as these expectations of these pullbacks coming at some point in time. We just don't know when. It's not going to be this week, and it's not in the next few days, but we know at some point in time there will be. So how can we trade and balance the risk that we have of us continuing to trend higher, as well as the potential for pullback that we've seen when we've got these types of indicators here in the past. So I'm going to break that down, as well as the trade idea in a strong sector. So let's go ahead and get started. Today is Monday, April the 29th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the market forecast here on the S&P 500. You can see I actually came really close to getting another cluster here with all four lines in the upper reversal zone. In fact, briefly throughout the day, we did have that. The momentum line did drop down out of the reversal zone by the end of the day as we closed a little off of the high, but look at the range, 10 point, half of the average range, and that average range is pretty darn small as it is. And again, you can see that 3 month that we talked about on Friday, back above 11% on the return. So pretty high levels there, and as I mentioned, this cluster we don't get very often with all four lines, and last two times in the last, there were only 2 times in the last 5 years, and both times brought the intermediate line below 50 almost immediately after. So that's not that that was a bad thing, right? Both times it was like this low point here. So to bring the intermediate line below 50 in the form of a bullish low point wouldn't be a bad thing, and neither one of them of those times in the past 5 years did it do that. So both those times it produced a low just like that, just like we expect to get, and you can see with these Fibonacci lines where we've got them drawn here. We can expect to get them. You can kind of get an idea of where we can get down to and by when. So we can get down to 2,800 here pretty quickly. It's only a 23% Fibonacci retracement. Now, granted, it's almost 150 point drops. It's going to be a more than a 5%, about a 5% drop there. It's going to be a little uncomfortable for some people, especially anybody who got really long, like in this area, even especially like with the all-time highs. If anybody got really long on the all-time highs, then they would probably hurt a little bit on a 5% pullback. It wouldn't be that big of a deal in the grand scheme of things, but in the short term, it would hurt a little bit. You can see if we were to drop further towards 38%, which is actually pretty normal for pullbacks, is to get to the top end of this Fibonacci retracement zone, then the fans here kind of suggest that we would get there towards the end of May, so about a month from now. So kind of gives us an idea of how far back and when we might be able to pull back to. Of course, as we keep moving up to new highs, all these lines move up too. So until we stop going up, keep an eye. Those lines can change. That 23% line, has gradually moved up to where it's actually at these old high points here, as well as a few touches in this area too. So you can see why that would be a support level for equities, and you can also see too from the Bollinger Bands and where we might pull back as well. Now that we're crossing above this little node here, that node's at about 290. That's going to be a support, but you can see if we were to break through that node, this is where right where my cursor is where that 23% Fibonacci retracement level is, right about 280. And you can see that's where another volume node is. So there's going to be some support in this area. It won't fall off won't fall off a cliff here. But if we were to break through there, you can see the vacuum of volume and where the next layer of support. And of course down here where the biggest volume point is, that's where that 38% Fibonacci retracement level is, where that big volume node. So you can see how they're lining up. The volume is lining up at those Fibonacci retracement levels as well. Let's go back to the market forecast. Take a quick look at the other indexes. You can see the Dow Jones Industrial Average not forming a new all-time high like the S&P 500. Its market sentiment's actually falling below 80th percentile, but that's not that big of a deal. It's about as weak of a posture as you can get from a long-term perspective. The intermediate line still above 80, so strong bullish posture. The near-term lines continue to bounce up into to the upper half of the chart. You look at the Nasdaq; it did get a cluster with all four lines. So that's now the S&P and the Nasdaq that have given us clusters here with all four lines, and more than 3 months into an intermediate rally. And then finally, the Russell 2000 came close last week, and this week, we got the 1598. The high point here in February was 1600, 1602. So still, it's the highest close of this rally, but it still hasn't been able to get above that high point of February, much less above, to even come close to testing the 52-week high or all-time high, like the S&P 500 is. But you have a strong bullish posture. Its market sentiment line's falling too, so it's not as strong. Not until you break out, right? Not until you really break out there and you sustain. See that the intermediate line did pull back below 50 on the Russell, unlike the other indexes. So it's had that brief pullback that we're expecting the other indexes to get too. All right, before we look at some other charts, just a reminder to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Click the thumbs up icon down below the video. That tells us that you want us to do the video again tomorrow. Quick, easy way to give us feedback. Also down there, comment on anything that you got out of tonight's video. Love to see what you're getting out of it. Join our Daily Market Outlook email list. There's a link popping up there in the top right corner of your screen. Click on that link. Very easy way to subscribe to our list. Follow me on Twitter for more content like this in between the videos, and join our Market Outlook community that we've created on Facebook. You can also subscribe to our mailing list here right below the video. Just scroll down to the bottom, just fill in this little address, click sign up for Daily Market Outlook email. This is what the email looks like. Timestamp summary, and down below, as you scroll down below, you can see the clusters watch list here at the bottom. Also, while you're on this page, 3 clicks. Number one, click on this heart right there. That will open up this window, and like tonight's Market Outlook tweet from there. Click on this image, takes you to your Facebook page. You can like and share today's Market Outlook Facebook post, and then also you can click here. That kind of shows that our community that we have on our website. That kind of shows people who are more engaged with this material on our website, so that you can engage with them. So 3 clicks, that kind of shows us, again, tells those social networks that you want them to keep pushing you the stuff that we post on those sites day after day. The more you engage with us there, the more that they know that, and they just want to make sure that you get all of our content. All right, back to the charts. Let's take a look at the long-term charts. And you can see, and again, it's only one day, but you can see how small the range is for this week. Again, the 10 points range. Yes, last week's range was 43 points. So obviously we're not anywhere. We still got a lot of week left, but you can also see, because of the Heikin Ashi Open being so low, how bullish this week's candle looks like, despite the fact that the actual range is so small. So that's why I say, again, we're not going to be pulling back this week, and next week at worst we'll get a transition candle. If we end up this week with such a small range, next week's has a high probability of being a candle like one of these here, or even like one of these. These are the types of candles that come after such a long extended runs that precede the bearish candles, right? So there's always going to be a transition candle that we can look for that will come after. So obviously not going to be this, most likely not going to be this week. If we take a look at the 3 green arrows, obviously we still have 3 green arrows here. The MACD is what's oscillating. The stochastics is still easily in the upper reversal zone, so buyers are in control. We're still easily above the moving average. Those aren't going to change anytime soon. So it's just really the MACD that's a threat to forming a red arrow. And you can see the MACD itself isn't close to dropping below 0. Stochastics not close to dropping below 50. We're still above a rising 8-day moving average. That momentum is not stalling yet. It's just flattening. So the reality is we're not anywhere close. I mean, as mature as a bullish we are, maturely bullish we are, and how that might limit upside returns from here, from this point, from this, from today's close. That doesn't mean necessarily that we're going to start tanking tomorrow, or by the end of this week, or maybe even potentially next week. There's layers to this pullback, and the first layer is to get below the 8-day moving average, which we, as you can see, we haven't. And then of course the the layer to get the 8-day below the 17-day is where the blue line crosses below 50, even just for a smidgen. That's your intermediate pullback. This, when it falls below and stays below, that's when you get the more of a market sentiment pullback, the orange line in the market forecast. But even just to get the green line below 50, usually that blue line has to drop below zero at least a little bit there. You can see on this chart how small today's range was. I mean, look how it was like, it did form a new 4-week high point, and it's a good thing because the 4-week low, remember, is really starting to move up pretty quickly. You can see how much it's going to move up tomorrow, the day after that, and after that, and after that. So, really by the end of this week, we'll be like right here, which means that dotted line is going to move up into this 290 area as well. So it's going to, we did get a new 4-week high, but that range, unless we really push up, and considering how the ranges are really small as we push up here, most likely we're not going to go up at the same pace to the upside that the low is going to be moving up during this week because of how big that move was at the beginning of the 4-week period. But it was a higher high and a higher low nonetheless. And again, you look at the range over here. Let's go to this chart and look at the range for SPY. 1.04 points. The volume at 57 million. Again, that's such really low numbers. As you can see here, 57 million is way down here at the low end of this 52-week range, and then one point is way below the low end of the 52-week range as well. So very, very low numbers, and you can see how we're starting to get to really low levels on the relative ATR as well. Again, that just means that it doesn't mean that we're going to tank. Doesn't mean that this is coming anytime soon. But it does, again, limit upside returns because we just really go slowly. We have small ranges and small volumes and volatility even. It's not as low. You can see it's starting to grind up as even though we get new higher highs and new all-time highs in the S&P, we're not getting new lows on the VIX. In fact, the VIX is actually staying right around the midpoint of this bullish range and a little bit higher. It's avoiding this lower half. So it kind of tells us a little something that not everybody is so complacent that there's a little bit of protection purchasing going on here. Not a lot, right? Otherwise it'd be towards 15 or higher, but a little bit, enough to keep it from going down while the S&P continues to grind higher. Now remember, we only have a day left in this monthly range. And the monthly range right now, unless we get up, we're probably most likely not going to drop below 11 tomorrow. Unless we jump up above 1439, which is the high point tomorrow, then we're probably going to end up with a really, really small monthly range. And, in the past, that's usually preceded jumps in volatility. Even if those jumps in volatility essentially just basically got us back to the range, the average range, right? The average range of the VIX being, here on the monthly chart. The average range on the VIX on a monthly basis being about 9 points. So 3.36 points isn't anywhere close. The previous month, we were under 6, and the month before that, we were under 5. So we've had, after a couple months of really high levels, we've had a couple really low levels of volatility, and that's, again, usually a sign that a bounce is coming. Now, not a bounce to 30 or 40, but, more of a range around 8 or 9 or 10 points, which, if we're going to have a low point around 10 or 11 would mean, a high point around 18, 19, 20. All right, so what do you think? What do you think about our market outlook for tonight? There's a link popping up there in the top right corner of your screen. It opens up a poll, so click that link. Then hit on the poll either agree or disagree, depending upon how you feel about our market outlook tonight. If you click on disagree, scroll to the bottom and comment down below on anything that you think, whether you're more bullish or more bearish than what we got here on this slow bullish grind higher, with still some time to go before we get more of an intermediate pullback and not just these short, quick near-term bursts to the downside aren't much of anything. So if you think we're actually more bearish than that, or more bullish than the grind that we're expecting to the upside, let us know in the comment section what you're seeing that would suggest otherwise. All right, well, let's take a look at today's price action, what's driving it. You can see crude oil had the biggest move today. Really, everything else, I mean, keep in mind, look at the scale here. Very, very small moves. I mean, developed markets and small cap stocks had a small gain. Gold had a small loss, a little bit of a loss too for the dollar. So interesting that both were down today. High yield bonds also down. Obviously, long-term bonds all down. So a little bit of risk-off move there. But you can see emerging markets were down. Even with the weak dollar and strong commodity prices, emerging markets didn't really outpace. In fact, it came in below developed markets. Only had a small gain by the end of the day. So, but strong move in crude oil. We talked about this before. This crude oil move we had a bearish week last week with that long upper shadow here, and you can see what today's move looks like in comparison. So we'll see, whether how much more bullish crude oil can stay because of the correlation that it's had with equities. It's one of the biggest reasons why equities have been so bullish. But you can see now its intermediate posture is more bearish, still weakly bearish, so it's not very strong. And the near-term line hasn't come back up above 50 yet. And a little bit of that divergence there here with these lower highs with the higher highs, and we've crossed below that, the low in between. So I mean, it's we're bearish here, and we haven't bounced back up. But today's bounce doesn't necessarily say, okay, now here we go again. We're still a little weak on crude oil, and that might lead to weakness in the broad market as well in equities. If you take a look at the dollar, which had that breakout move, you can see how the dollar hasn't been able to hold that breakout move. In fact, now we're back down below 98, and we'll see if we end up this week below this 97 2/3 level, which is where these old highs were before we broke out last week. So very important for the dollar, because if that breakout ends up being a fake out, those tend to be pretty bearish. And you can see short-term sentiment is about as bearish as you can be on a short-term basis. That would suggest more of a pullback on the intermediate line. If you take a look at the 10-year note actually bounced up a little bit, but you can see it's still on its bearish decline. It's got a weak bearish posture, light pink shading, but the intermediate line is falling, and you can see it's actually a bearish intermediate confirmation signal when you include the slightly overbought momentum line. So we'll see if that leads to more weakness in yields heading into the rest of this week. As we take a look at the different foreign markets and how they performed, you can see some of the developed markets actually performed the best here. Italy and Spain, kind of the emerging markets, so to speak, of the developed world. France also doing well. Germany, all these European countries. South Korea bouncing up after being very, down here in the bottom right corner, being very low below its moving average. You can see a lot of pink here, even though the U.S. got this overbought cluster. Lots of pink, but not pink on everything. Japan's got a new 3-month high. Germany's got a new 3-month high. You can see Canada's green with a strong bullish posture, rising moving average. Brazil's trying to get back to bullishness, so it's got light green shading here, 30 on the intermediate line, and still got this red line here. Everything else is kind of softening up. Yellow moving averages were trading below. I mean, they were not strongly bearish, but they're not as strongly bullish anymore either, and that may eventually reflect into what we haven't seen yet on the S&P 500. From a sector standpoint, it's interesting to see financials bouncing back up. Financials have been struggling so much with this yield curve inversion and with yields falling. But look at the sector, overbought cluster on Friday, and then a new 3-month high today. So it's kind of breaking out a little bit here, which is kind of interesting to see, because when you look at it from a longer term perspective here, it's broken out. It's got the almost got a strong bullish posture here on the intermediate line, and the moving average is finally turning higher after turning up above it. So kind of a similar pattern to what we had over here back in early 2000 or summer 2016, when we had broken up above and turned things around, but then we kind of went sideways here for a few weeks, a couple of months before that breakout move. See if we get a similar pattern on that there. Everything else, I mean, look at utilities starting to go sideways, interest rate sensitive area. Some little weakness in the strong technology, discretionary, communication services forming a new 3-month high point. You can see real estate and utilities kind of rolling over. They had been so strong, they're rolling over here. Energy is weak. Healthcare remains weak despite its little bounce here. And then where's the material sector here? Materials is above a rising moving average, but is showing a weak bearish posture. So we're getting some pink in these dollar sensitive areas, and we're getting some weakness in these interest rate sensitive areas. Which means, you have to kind of be picky about what you trade and how you trade, whether you're trading bullish or bearish. Because if you're trading bullish, what's the returns going to be like from today going forward? How much are we going to grind? If and when are we going to get a pullback? If you're bearish, you're going against a strong trend, so you have to be really picky about any kind of bearish trades you make. But again, technology continuing to lead, and if you take a look at a stock like here, let's pull up this market forecast first. You pull up Palo Alto Networks, and you can see a little bit of a breakout move. We're not quite closing up above these highs because we had this kind of post-earnings breakout and then sideways move. But you can see now the intermediate line's taken off, is more bullish than it's been since this pullback. So the intermediate line might be breaking. Even if we're not getting a higher close, the intermediate line's breaking out, getting above its market sentiment line again. And we have the dark green line, dark green shading combination there. We also have the 3 green arrows for Palo Alto. Not a whole lot of volume, but keep in mind, remember how low the volume is for the broad market as a whole. So 3 green arrows. You take a look at the long-term view for the stock, and we had broken out to new highs on that earnings. This whole sideways action has been a retest of that old high point, and now we're bouncing off this last couple of weeks, the 50-day moving average, and so far this week closing above all those weekly highs. If not, not the weekly highs, but the high closes, the weekly closes. So you can kind of see that bullish pattern developing there. Let's take a look at its volume profile, and you can see this little 70% volume channel is at 247.19, and we're closing up to 249 today. So we kind of broke out above that. Very, very little volume up here for some support in this area. Very little resistance above that area. You can see the Bollinger Bandwidth is starting to widen out as we push up on that upper band. Then you look at the DMI and you say, okay, well, let's take a look at the DMI, and you see that it's positive, DI positive indicator. The positive directional index crossed above 25, almost crossing below 20 in the negative directional index. So that's the kind of pattern you like to see on the directional indexes, the average directional index. So of course that brings us to the options, because again, we have to be very kind of picky here. We can't be too aggressively bullish. We just don't know when the market's going to be bullish and how bullish it's going to be. And especially with the lack of volume that we see, we're not getting the volume in a broad market sense. We're not getting the stock giving us the 1.5 times. So if we were to sell this 240, it's a relatively wide spread, but keep in mind how expensive the options are. So if I sell the 240 and bought the 230, a 30% return on risk for a $10 wide spread would be $2.32. So even if I were to get filled in, say right around 288, that's still more than enough credit. If I were to analyze that trade and throw the slice to break even, let's move this up here to the expiration for June. So you can kind of see where the stock can trade. You got a pretty decent probability of closing up above there. And if I were to put those, let's go to the chart, just go back to the Bollinger Bandwidth here. There we go. And then let's go and throw those slices on the chart for that trade. So we'll put that right here. Then you can see here the break even is below this sideways action, so, and back below that old high point. So that's kind of where it would have to fall for us to lose. Again, we're trying to go for $288 in this case. So for us to lose $288, we'd have to move in, right around this 233 area. So actually a little bit below that 237. So down in here. So you can see we've got some pretty decent support that would try to keep us up above that. To where we can keep our losses at that 288 level or less. The maximum loss, of course, would be $712. by going for that $288, or if we can get half of that quickly, we'll take it and then move on to another trade, because again, as I mentioned to you before, you can see how fast and easy it is to get the first half of this, and then how long it takes to get the other half of the spread. So if we can get that first half quickly, great. We'll take it and move on, take the $144 and move on to something else. Alright, so that wraps us up for today. Now I want to hear from you, so use that link that's popping up there. Open up any new thread in our forums on MarketScholars.com and our Market Outlook forums. The class forums are premium for our premium subscribers, but the Market Outlook forum is free for anybody who subscribes to the free portion of our site. Remember, I showed you how to do that earlier in the video. But love any questions or comments you have. Make sure you open up a new thread there. Remember, you can also reply to anybody else's thread too, and try to keep the conversations going in between these videos that we have. Again, thank you very much for watching our video. Remember to subscribe to our YouTube channel, click the thumbs up icon, and comment on the video. Follow us on Twitter for more content. Join our community on MarketScholars.com, as well as the community we created on Facebook. Have a great rest of your evening, everybody, and we'll see you all next time.